Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Wednesday, October 26th, 2022. What numbers did we get today? We got a look at trade and inventories, and they both are going to lead into the GDP number for the third quarter that we will get tomorrow. So what did we see? We saw a miss both in terms of the trade deficit being higher, deficit being higher, and we saw less inventories. So what does that tell us a little bit about inside the numbers? Exports are struggling. The strong dollar is hurting US manufacturers and also the travel trade here in the United States. So why is that? Not surprising. It's now a good time now it's a good time for foreign companies to import, because if they're cheap currencies, ours dollar is expensive. It's been very strong. Lately, we've seen a little bit of a decrease in it, but global energy issues, global conflict are all playing into it. Just think about the China numbers that we received. They were weak economic growth. That's telling us that food, important part of trade, is weak. We actually saw a 14% decline month over month on food exports. Imports still moving along at a modest clip. So they are seeing some supply elements coming into this economy. So the supply chains are doing a little bit better. So that's good news. However, when we look at exports, that adds to GDP, it'll probably be a disappointing number tomorrow. Another thing that adds to GDP is more inventories. And we've been really missing inventories, as we all know. And so when you look back, only it took till this year for us to achieve the inventory levels that we had in February of 2020. Since then, retail sales have skyrocketed, coming in roughly at 700 billion per month. Before that, they were 520 billion. Huge move up in sales, no movement in inventories. We have finally seen inventories move up. So they're now roughly at 740 billion. That's a good number compared to where we were at the beginning of this year. So good movement forward, tells us supply chains would expect some improvement in inflation readings because of the lack of shortages and more things on the shelf. So as we stay here and look for tomorrow, inventories should add a little bit. And we're looking at roughly a 2.2, 2.5 growth number. Previous last two quarters have been weak. Remember, significant headwind. GDP is a real measure. So we take out inflation. Inflation's been high. So that subtraction is rather heavy right now in the economy. So that's going to kind of mitigate. Consumption should be modest, should be higher, but not a lot higher. Still, we're running car sales at less than 14 million units per month. In better economic conditions with more inventory, we'd probably be running near 16 to 17. So yeah, consumers are buying, consumers are paying over list, but they're not there. And remember, we got news yesterday out of consumer confidence that people are still eager to buy these large ticket items. So inventories are going to be a little weak, and inventory is going to be a little strong, I meant to say, and that should help us as we move forward for the consumer. Fixed investment, both on the residential side and the business side, is going to continue to be weak and even further hindered by what we've seen in terms of higher interest rates. Still look for the intellectual property number. That's been a strong growth, growing 5%, particularly throughout the last decade. So we should continue to see that add to the economy. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.